Welcome to the deep dive. If you look at the news today, Boeing just seems like a company in this perpetual crisis. But today, we are jumping right into a highly detailed May 2026 financial research report from BofA Securities. And our mission here is strictly to unpack their core conclusion.
Yeah, and it is a really surprising core conclusion when you actually look at the daily headlines. Because despite all the public relations issues, BOF is actually reiterating a buy-buys rating.
Right.
And they set a $270 price objective.
Right, which is huge considering the stock is sitting around $229.
Exactly. I mean, Wall Street is looking completely past the surface turbulence. They are focusing on what report literally calls size baby steps.
Size baby steps, okay. So we're going to keep this completely to the point. We're going to look at three key pieces of data, then the core driver of this valuation, and finally, one major core risk. So let us get straight into the data. What is the first key metric here?
Well, the first key data point is all about the commercial core. The 737 MAX program has officially stabilized at a build rate of 42 aircraft per month.
Okay, so 42 a month is the baseline right now.
Right. And, they're pushing to hit 37 MAXs per month by the third quarter of this year. Now, I should mention there was a minor wiring issue in the first quarter that delayed about 25 planes.
Wait, really? A wiring issue delayed 24 planes?
Yeah, it did. But BofA actually views those as just pushing into the second quarter.
Yeah.
They are not lost sales. The underlying line is fine.
Okay, I see. But the report also says that hitting the next big milestone, which is 52 planes a month, that is unlikely before 2028. Why does adding just 5 more planes take 2 full years?
I mean, it is a physical limitation. To build anything over 47 a month, they literally have to spin up their new North Line factory up in Everett.
Oh, wow. So they were just completely out of space.
Exactly, yeah. And, starting a whole new line takes immense labor and crucial FAA approvals for those specific processes. It is slow by design.
Got it. Okay, so that is data point 1, the max stabilization. What is the second key data point?
So the second piece of data is on the 787 program. They are successfully pushing toward 10 planes per month. And that is despite some seat certification delays they hit in the first quarter.
Seat certifications? You mean like just the paperwork for the passenger seats?
Literally, yes.
Oh.
Every single configuration has to be certified by regulators. If a third-party supplier is late with their seat paperwork, Boeing, they cannot legally hand the plane over.
That is wild. You have a $100 million machine waiting on a piece of paper.
Right. But again, BofA sees this as a minor speed bump. The supply chain is finally finding a rhythm, even with these tiny hiccups.
Okay, so production is stabilizing.
Yeah.
But then we hit the third piece of key data, and well, this one seems completely backwards to me.
Oh, you mean the earnings estimates?
Yes, exactly. BofA actually lowered their 2026 and 2027 earnings per share estimates. I mean, for 2026, they dropped the EPS from a positive 90 cents all the way down to a loss of 85 cents.
Yeah, a negative EPS. It is a big drop.
Right. They are predicting the company loses money next year. So how in the world does that support a buy rating?
Well, so this is entirely driven by their acquisition of Spirit AeroSystems. Boeing is essentially buying a massive piece of their own supply chain and bringing it back in-house.
Oh, okay. So they are absorbing all of Spirit's old debt and problems.
Exactly. When you buy a struggling operation like that, you take on their inefficient contracts, severance packages, upgrading their factories. It causes massive short-term financial indigestion.
So BofA is just writing off 2026 completely.
Pretty much, yeah. Because they are looking at a different metric. They are focusing on normalized free cash flow.
Okay, break that down for us. What does the cash flow look like?
So if you strip out the one-time integration costs of buying Spirit, BofA projects that free cash flow is going to jump massively from about $2.5 billion in 2026 up to nearly $9 billion by 2028.
Wait, $9 billion, that is a massive leap.
It is huge.
Yeah.
And, that is the core logic of the buy rating. You take the short-term EPS loss today to lock down your supply chain quality, which guarantees that $9 billion cash flow later.
Which brings us perfectly to the core driver of this entire report. 2028 seems to be the magic year. Why is that specific year the major inflection point?
Well, the core driver here is a concept called order book vintage.
Order book vintage.
That's right.
Okay, what does that mean exactly?
So, during the darkest days of the pandemic, Boeing had to offer massive discounts to airlines just to secure any orders at all.
Right, because nobody was flying.
Exactly. And those heavily discounted low-margin planes, well, those are the ones rolling off the assembly line right now. They're doing all the hard work for very little profit.
Ah, I see. So the financial pain today is just the ghost of those desperation contracts from years ago.
You hit the nail on the head.
Yeah.
But the planes ordered after the pandemic, when travel surged back, those have much, much better pricing terms. And by 2028, deliveries of those high-margin, post-COVID aircraft will finally surpass 30% of total deliveries.
Oh, wow. So you just have to survive the low margin years to reach the high margin vintage in 2028.
Exactly. That is the core driver of the $270 valuation.
Okay, I mean, the logic is sound, but Wall Street models are, they are perfect in a spreadsheet. Real life is messy.
Oh, yeah.
So let us talk about the core risk here. What is the one major thing that could completely derail this 2028 payoff?
I would say the absolute biggest threat is macroeconomic risk, forces totally outside of the factory walls. Specifically, BofA flags an unexpectedly strong U.S. dollar or a surge in oil prices above $100 a barrel.
Okay, oil makes sense. If jet fuel is too expensive, airlines bleed cash and they stop buying new planes. But why is a strong U.S. dollar a core risk? I mean, usually a strong dollar is a good thing for the economy.
It is great if you are a tourist, sure. But if you are a massive exporter like Boeing, it is a nightmare.
Why is that? Because of the exchange rates.
Exactly. Commercial aircraft are universally priced in U.S. dollars. So if the dollar suddenly gets much stronger, Boeing's planes instantly become 10 to 15% more expensive for international airlines to buy.
Just purely because their local currency does not go as far.
Right. And meanwhile, Airbus is based in Europe. They operate largely in euros. So a strong U.S. dollar artificially gives Airbus a massive pricing advantage globally, and they do not even have to change a single thing about how they build planes.
Wow. So Boeing could execute perfectly. They could hit 47 Masks a month, integrate Spirit flawlessly, and still get totally hammered by currency shifts.
That is exactly the risk you have to weigh.
Well, that is a sobering thought. But to sum up the investment advice from BofA, they are maintaining that buy rating and the $270 target. They believe that fixing the supply chain now, even if it hurts near-term earnings, is the right move to secure that massive post-COVID cash flow by the end of the decade.
Yeah, they are betting on the long-term foundation over the short-term noise.
All right, well, that wraps up our analysis for today. I highly encourage you to subscribe to this channel because our next deep dive is going to be even more exciting.
Yes, thank you all for joining us and listening in.
And please remember, this video is for research and analysis purposes only and does not constitute any investment advice. We will see you next time.